Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, and I'm here with our fourth quarter video call, but actually it's the beginning of 2024, and a lot of things happened in 23, and I think a lot of things will happen in 24, but just a few items that I want to mention to you is speculation's back. And they're buying all the cryptos again, buying the companies that don't make any money, and all of a sudden in a 6 or 7 week period, here we go again. Secondly, the Federal Reserve has done a flip-flop. By that I mean only 7 or 8 weeks ago they were saying that, hey, we're not out of this yet. We need to hold the line, keep things strong, stay with it, keep the rates up, etc. They walk into this meeting and decide at the meeting, I guess, that, hey, let's loosen up a bit. Maybe they're throwing a bone to the market for electioneering or something, or maybe it's a situation where they really are worried about something. We don't know what it is. I have to say we don't know why, but that changed the interest rate situation going forward. And it also set it up to where people are saying, well, happy days are here again. The last time that was used was 1932, Franklin Roosevelt running for re-election, or election I should say, and he didn't realize, and they didn't realize, that the next 13 years would be pretty rough. A change is coming in the bond market, in our opinion. We'll talk more about that in a little while as far as what we think you should be doing. I don't think it'll be like the last 40 years of the bond market where rates were declining. And I think you're going to have to be careful of consensus thinking, because it is very high now. The consensus about everything is high. That means that everybody's thinking the same way. Let's look at the economy though. The first one I wanted to put up, because I know you're going to ask it, is what happened to that recession call? And we thought by the time we got into the fourth quarter that things would be slowing. And in reality, they are, okay? But GDP didn't slow because of this one thing. The government spent more money this year in 23 than they did during COVID. And you look at that and think, how could that be? Well, we'll show you when we get down into the bond section, but they kept pressing it to put more money in. And so that was the largest increase to GDP this year, was the government. You'll also see underneath all that what's going on is manufacturing is really declining. Manufacturing employment, manufacturing output. And you'll notice here how many consecutive months of contraction we've had in that. That's been a problem. Secondly, you'll see job openings. Job openings are declining. Quits are declining. All of that is slow to happen, but it is happening. And one of the things we talked about last year, all year, was the excess savings from all the money got put in by the government and the Fed would probably fade out in time. And we're very close, as you can see in this graph now. We're down to where excess savings is on the low end of everything. Another thing's happening is pending home sales. Pending home sales at a new low. Existing home sales, new low. One of the things I think people don't realize is that if you have a 2.5% or 3% mortgage, it doesn't make any difference if rates come down to 6.5% mortgage or 6% mortgage. You're still paying twice the money. So it doesn't necessarily bode that well for the housing market for this last dip that showed up. And maybe they come back to a point where it's better than it is now, but we certainly don't think it'll ever go back like it was. And so that's going to be a change in that housing market. In addition to the housing market, you have multifamily construction, apartments going up everywhere. They'll hit a new high this year. That's putting pressure on old apartments because they both are now going to be working on rent. Rents are declining somewhat. We'll see how that affects the economy. I want to just show you one thing in Europe, because Europe is really in a recession. I mean, there's some deep things going on in Europe, and we think this is just one idea. This is German residential property prices year over year. They're down 15 points. Now, if we have the rest of the world go into recession, it's going to be very hard for us to be able to push through that. But we're starting to see quite a bit of that in Europe right now. One of the things I wanted to mention, and you'll know that we own gold in 2 of our strategies, and in the 3rd strategy we own the gold miner. But one of the things that's happened, if you look back since 2000, really gold has outperformed all these others. It's outperformed the markets, it's outperformed everything. I know people will say, well, yeah, but it had a low period there between 2011 and 2016. It did. but that's part of gold. It moves around some, but we feel like a part of that ought to be part of the portfolio. So if you go into the bond markets, I just had to show this because these were the headlines that came out, when they decided that they would move the debt limit to 2025. And it's interesting, both parties agreed on this, by the way. It's not a political thing. They both decided that. So it's open-ended. They can spend as much money as they want to spend, and which they have done, by the way. If you look at this particular graph, and I've shown it to you before, the world debt clock, we just crossed 34 trillion in debt. That means if you look backwards, 72 days ago, we were 33 trillion in debt. We moved $1 trillion in 72 days. And when you read our market letter this time, which will be out next week, you'll see I mention in there that if you look at $1 trillion and you want to know what that looks like, if you spend $1 million an hour, it'll take you 114 years to spend $1 trillion. You need to think about that. So what's happened? With the movement in interest rates now, the government's spending 35% of tax receipts on interest. Now, what we're seeing in all of this is it may not happen this year, but sometime we feel like in the next, this decade, next 35 years, some number, we're going to have a real problem with our debt. And that is the fact that nobody's going to want to finance it in time, and they'll push those rates to extreme levels to have to finance it. That's when we hit the wall. And that's something that's changed our mind a little bit on the bond market. We'll talk a little bit about it. But the other thing's happening is if you look at what the institutional side is doing, they're basically taking, if you look at collateralized loan obligations, which are basically pools of debt that go to private equity, et cetera, and that's over 70% now, okay? And so the people that are buying those CLOs, I don't think are aware of that where that is actually going to and what that could cause in times of rougher times. One of the things I've noticed is that we may have another Arthur Burns on our hands like the 70s with Jay Powell. He just switches and goes back and forth, says what people want to hear, and then he goes back the other way. So we tracked this back to 2014, and it looks as the same. If you overlap it with what was going on in the 70s on the bottom line, you'll see that Arthur Burns and Jay Powell were somewhat alike. If that's the case, that means that they won't be able to keep this quote-unquote soft landing, everything's Goldilocks. We'll see what happens, but that's what we're looking at. Another thing we're looking at, and I want you to be aware of this, if you look at the period between 1965 and 1991, rates were all over the place, up, down, up, down, up, down. It was a tough time to trade bonds because once you got into the 80s, yeah, the bond yields started drifting down, but you couldn't just buy a 15, 20, 30-year bond because it'd go down in price on you. And you'd have to trade it. If you did buy it right, you'd have to trade it eventually, and people don't trade bonds. They don't have that mentality. We will trade them, and we just traded some. But what happened coming in that period when they started really sort of juicing the markets after Greenspan is the rates stayed low for a long period of time. You see that portion between 1991 and 2021. And what that did is that got people to thinking that they're always like that. That's really not the norm. The norm is the one on the left. And you see where we're starting to go back into that? We really think that that may be the case this decade. And if it is, you're going to need to keep your maturity short and not get caught up in trying to buy long maturities all the time and hope you're right and hope the Fed bails you out, because there's probably a spot where they can't bail you out. On the stock side, we included this graph in the market letter that you'll get next week. But one of the things we mention to people is, look, we're in it for the cycle, not today or a month trading or the last 6 months or whatever. And people are always talking about, well, I own the index only. Well, if you own the index and you owned it 2 years ago, you own the same price you have today. So you really haven't made any money. You would have made more money in a 3-month treasury bill. And people need to think about that. Most people are not zoned. We made a comment in our market letter that if you'd only invested 1 year in your life in 23, you did pretty well, 1 year. But you have to look at the full cycle. The other thing that happens is we got up close to a high like we did really the latter part of December here, the last few days. It reminds us of 2000 and also of '07, where we hit a high and we backed off, traded, and then we came up, and when we got back to that high again, everybody was like, hey, we're ready to go now. It's going to be a new bull market. And we saw it both times, and the markets fell 50% or more both times after you came back up to that high. We just did that again here, by the way. I don't know what's going to happen from it, but I will tell you this. At a 21 times multiple of earnings, you're not situated for a brand new bull market with that. I laugh at this slide a little bit, but I've watched this movie. It was a little bit before my time, but it was a movie in 1960, and you had all the great stars, Steve McQueen, Yul Brynner, and out of those Magnificent Seven people, 4 of them didn't make it, by the way. Ended up badly. Reminds me of this Magnificent Seven we have now, which I'm sure that a few of these won't do that well either over that long period of time. And speaking back to those Magnificent Seven that we've just seen, look at the Magnificent Two, and that would be Apple and Microsoft. And by the way, we own those two for legacy accounts. We haven't bought any, a little bit in both. We haven't bought any in a few years, but here's the situation. If you just take the market capitalization of those two stocks, okay, they're worth more than all of the market cap of energy, real estate, utilities, and materials, which is a big, big group of stocks, okay? They're also about 3 times what the energy sector is, just those 2 companies now, okay? And then there's 70 times what all metal and mining industry is. So we have some serious concentration going on here that you need to keep in mind. So if you ever go back into a commodity cycle, that will change in time. But that's how concentrated this stock market is. The other thing that's going on right now is these are asset managers right here. They're all in. This basically goes back 14 years. They're the highest percentage they've ever been in 14 years. They're in the markets. They believe that, hey, everything's going to be great. Jay Powell's going to take care of us. And what it's done is it's also made individuals do the very same thing. You'll see that individuals right now, okay, if you go back the same period of time, their inflow is the highest that's ever been into stocks. Matter of fact, if you look at 1 month of the S&P, just we call it the SPY, the SPY, but they put more money in than any period going back to 1999. So the individuals are all in. They're in this market, and they think we're headed higher. Interesting thing, and we call this out over and over, that the SPACs, this would not be a good situation for investors. And Wall Street sold it big. They brought people in. There's probably no telling how much money's been lost in this group. But just right now, just in 23, $46 billion worth of these SPACs in bankruptcy. And we probably got a lot more to go, honestly. This was an area that should have never been, really. And if you look in summary, just to give you an idea of where we are and what we think, okay? And I'm not going to tell you everything we're doing, but I will tell you a lot of things we're doing. You should not try to get caught up in chasing yield right here, thinking that the rates are going to go down, 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 I've got to get on here. There's good probability that this decade, that rates are going to normalize higher, meaning instead of a 2% low or what we had for a long time, a quarter, you're going to be more like 3 or 4. And if that's the case, you don't need to be out there, chasing yields to try to get that extra half a point, because it could hurt you. The second thing, right now, liquidity pays very well right now. You'll see it down below, but if you look at a 90-day treasury, it pay you 5.35%. No risk whatsoever. And the other thing, our changing approach to fixed income is this. While we do think rates will probably decline over time, and it will be good for the bonds we have, I think the change we'll make over the next 3 to 5 years is this. I think you'll find us buying very few longer bonds, say 20 years or longer, and you'll find us buying a lot more paper that's 5 years or less. Because that's how you have to work through a period. You have up and down interest rates, and particularly with inflation. Where are we right now? We've made some, just defensive purchases. If you look at our small position purchases, you'll see all the names you know. Coca-Cola, Kroger, Kimberly-Clark, Johnson & Johnson, good yields. They pay good dividends. Larger positions we have with yields, Enterprise Products, MPLX, AMLP, all, basically 8%, which is a very good cash flow piece right now. And our largest position by far is the 90-day U.S. Treasury floating rate position. And it pays about 5.35 as of today. So I hope you get an idea of what we're thinking here. We don't know anything about what's going to happen this year, but I do know this. I know we know what we own. And if something changes on that, we will make a change. And I'm hoping that we're able to work through this next period, because it's going to be, if you look at everything going on in the world, particularly the Mideast, what's going on in this country, foreign money, currency, the whole thing, we really have to be on our toes, I think, this year. But I want to thank you for watching in and let you know that if you have more questions, you can certainly give us a call or come to the website, oxbowadvisors.com. And with that, appreciate you watching in. We'll see you next time. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.